listeners. My name is David Scaysbrook. I'm the managing partner and co-founder of Quinbrook Infrastructure Partners. And we're a global specialist investor in real assets, particularly in renewable energy. Well, I think first and foremost, renewables are not a special asset class. They're power generating assets, and the power sector is going through huge change at the moment, both from technology, regulation, and fossil fuel plants retiring at an accelerating rate, coming up to 30 or 40 years old. So it's really dealing with the dynamic risk associated with all of those changes. And so revenue certainty is the number one issue, challenge, and opportunity for institutional investors. So from a risk perspective, we would say that in the last 30 years that we've been investing in power markets, revenue risk these days is at its most acute. And so that poses a challenge for any institutional investor, particularly pension funds that are looking for stable revenue streams. Then the power industry has some challenges because of all these changes that are happening simultaneously. And so therefore, really the key risks to avoid are those associated with a very rapid and huge influx of new renewable energy onto the power grid. And that's producing a range of volatility, not just because renewables are becoming cheaper, but because you've also having it's challenging older coal, nuclear and gas plants, which are retiring at an accelerating rate. So in a nutshell, the forces that drive price formation in power markets are fundamentally shifting. The opportunities there are, okay, how do you protect yourself against that? How do you protect capital, which is the number one requirement for institutional investors, particularly pension funds? How do I protect my capital base if I want to get access to renewable energy, which is a power asset? Biggest issue hanging over the market, the elephant in the room, in many respects. And so, we see opportunities in the market where we can get back to long-term contracts, contracted revenue streams through a very different way of tackling the way renewable energy couples with energy intensive industry, such as green data centers, green hydrogen, green steel manufacturing. Perfect example is only this morning, BMW announced that they're sourcing all their aluminium from their cars from aluminium smelters that are fueled by solar power. That is just one example of the sorts of transformations that are going on. So there are ways to play the market more safely and still generate decent returns, but you've got to look for the linkages between large-scale, low-cost renewable power and energy-intensive industry that's looking for low carbon. We see institutional investors are bombarded with wind and solar projects and funds focusing on wind and solar. Yes, they are the two dominant, if you like, technology choices in most renewable strategies these days. But our view is the market doesn't need another wind and solar fund in the way it's been traditionally shaped, up till now. So we've been more interested in the areas of the power and transmission system and power markets that are going to change and offer opportunities for investment as a result of these changes. So I'll give you two examples. So in the United Kingdom market, we decided not to invest in renewables out of our most recent fund. And the reason for that is we just saw all the return opportunity eroding for renewables for a variety of reasons. But then we saw an opportunity to invest in grid support assets that had 15-year AAA government contracts with revenues fixed and escalated with inflation. And you just could not get that in renewables. And the return on offer was 2 and 3 times. The second thing we've invested in, and this is a first for private capital in the UK power market, is we're invested in a 100-year-old technology, which is the key to supporting new renewable energy coming onto the grid, which are called synchronous condensers. And a synchronous condenser is a dream asset for an institutional investor because it's essentially just a spinning wheel inside a case that provides what we call inertia for the power geeks out there. It provides inertia to the power system, which is lost when coal and gas plants retire. Solar and wind don't provide that, but it's necessary for the power market. And we think we'll do quite a few more of those. And, you know, these are relatively quite low risk, classic infrastructure type investments, which are making considerably higher returns at lower risk than the renewables that are coming in that creates the need for the assets in the first place. So there are these niches of opportunity in grid support where you can, if you like, be exposed to the energy transition, but in smart ways that are safer for institutional investors than, let's say, the standard fare wind and solar projects, which are being increasingly exposed to that revenue volatility we mentioned before. It's always been a feature of building new infrastructure, but investors these days value understanding the attribution of the impact that their capital is having. And so when you invest at the intersection of new asset creation in the energy transition, you are investing in the development and construction of new assets that are going to make a difference. And the way they make a difference is through their impact, which is a combination of their environmental, social, and governance benefits. And a good ESG manager will measure all of that and report against it and provide that transparency. And so the key message really for infrastructure investors, institutional investors, is if you want higher risk adjusted returns and you value making an impact from an ESG perspective, from the deployment of your capital, you need to look for strategies that are creating new assets, not simply acquiring ones that are already built and operating.